on the first deal, I partnered with who at that time was an established investor, a contractor, and then myself. So I had who I believed were mentors, and they actually were. My flaw was that I had too much trust and I didn't actually look at the numbers. I trusted the investor to run their pro formas and tell us how much money the deals would make. Then I trusted the contractor to know his numbers and tell us how much it would cost to execute. We ended up losing money.
This guest is one of the leading lenders in the country, having financed over 600,000 deals and over $300 million in loans. Today we're going to learn the ins and outs on hard money lending, construction, and overall investing in real estate. Thank you so much, Israel Lopez, for being here today.
Hey, Ian, thank you. It's a pleasure, and I love everything you're doing with your team, so it's always a pleasure.
Man, yeah, thanks for making some time to come on. I know doing 600,000 deals and still finding, a little bit of time to come share some of that wisdom with us today. Definitely appreciated. So thank you for being here. Israel, before we dive in, obviously there's an amazing story to tell to get to the point where you're doing $300 million worth of deals. But maybe take us back before, growing up, before you were, one of the biggest lenders in the country. What was life like for you early on, and how did you really get started?
I don't really tell this story much, and no one really has asked me. So I've actually been working since I was 12 years old. My mom, single parent, entrepreneur, owned a Mexican franchise. My grandfather had immigrated from Mexico, and he and his brother started Mexican stores, branches in the greater Pacific Northwest, a couple in Kent, a couple in Burien, and we had one of the franchises up in Marysville. So I early on was already introduced to entrepreneurship and having to work and understand what it meant to pay the bills early on. So growing up in her business allowed me to learn a lot of hard work, people skills, and negotiation, because my people tend to negotiate a lot. And that, I think, was the foundation for who I am today, because if it wasn't for that, who knows what I would be doing. There was definitely a lot of times where my life could have gone south, a lot of alcohol abuse, drugs, gangs. My uncle, who I looked up to, who was 3 years older, was a gang member in the Burien area. So early on, my life could have gone sideways, but the number one thing that helped me stay the course was that store. It allowed me, when I wasn't doing my homework, I was focused on the business. I was actually at the cash register, bringing up people and providing services, whatever they needed. I mean, we had everything from medicine all the way up to like something as simple as a soda. So early on, I got exposed to dealing with folks and helping them provide a solution for whatever it is that they needed, that they were walking in the door for. So that's a little bit about my background. And thank you for asking about that. But that's really where everything started, really. After I turned 17, 18, I went off to college. My shining light outside of the business was the UW sign, the University of Washington. When you drive through I-5, you see that purple W on the building, and I always knew I wanted to go to college and build a legacy, and I never knew how, but I knew I wanted to pursue something further. Went off to college, didn't go to UW, definitely applied, but I ended up going to Seattle University, actually pursuing medicine. So that's another fun fact about me. I did 4 years of medical school preparation all the way up until I had to apply. So in college, I had 3 jobs, worked at Harborview, Swedish Hospital, and I did virus research. After doing all that, I realized it wasn't really the life that I wanted to live, and something deep inside me told me that was only going to be a stepping stone to go into real estate. And I asked myself in my last quarter, why was I going to spend 7 or 8 years of my life going into medicine when ultimately I wanted to get into real estate? That's exactly what I did. In last quarter, I got a minor in finance because I majored in cell biology with a double minor in chemistry and finance. The finance, I slid it in there at the end because I knew somehow it would help. So I dropped the medical career, went straight into real estate. My first year in the business, I was working with some of the biggest names today, Leka Devatha, Jimmy Tang, who at the time I never thought I never thought anything of it, but today they're really big names in our industry where I was definitely blessed to have them as early mentors and people that I had the opportunity to work with, to the extent that we were doing 20 studs out remodels and 2 new construction builds in year one.
Wow.
And
Okay.
that's where I really got introduced into real estate. My second year in the business, I actually did my first 2 flips, lost 100 grand, because ultimately it was my fault. I didn't know what I didn't know, and uh, I made poor decisions. I bought 2 properties where we overspent on the renovation budgets, and we bought with too slim of a margin. The market was hot. We thought we'd be okay, but I got burned early on, and that was only a lesson. That was one of the early lessons in real estate that I knew I would never make again.
Right. Wow. Okay. That's a lot to cover. I mean, I never realized, that background in terms of, you were going the medical route, entrepreneur at a young age. And it's kind of funny looking back how all of that has played out. Would you, when you were first starting out doing the real estate side, what were you doing to get funding for those types of deals as a new investor? It sounds like you did have some mentorships and some things like that, but maybe I'm wrong, but I wouldn't imagine that they were co-signing for you just fresh on your first deal. So kind of curious, and a lot of people listening are probably curious, how do you go about getting financing on that first deal or first couple deals?
Yeah, so on the first deal, I partnered with who at that time was an established investor, a contractor, and then myself. I put in half of the down payment. So I had who I believed were mentors, and they actually were. My flaw was that I had too much trust and I didn't actually look at the numbers. So I trusted the investor to run their pro formas and tell us how much money the deals would make. Then I trusted the contractor to know his numbers and tell us how much it would cost to execute. When we actually got to it, we ended up losing money, which was not the end of the world. It actually, those losses, if I were doing it on my own, those losses would have carried. I would have carried all the losses by myself, but it was carried amongst 3 of us, and we got hard money lending on those deals early on. So really, you don't have to have experience to get hard money loans. And there's, just like everything, there's good players in the lending space and there's bad players. There's and not necessarily bad. There's more of players who will actually vet the deals for you and players that just trust that you know what you're doing. So that's, I think early on I didn't have a lender who told me, hey, you might want to look at this deal a second time because of X, Y, and Z. But even then, a lender doesn't know that you might go blow through your budget or something may go wrong in the project. But yeah, it was a double whammy, basically buying it at a high price point and overspending. But the hard money loan was key to get in my first couple deals.
Gotcha. Okay. And for those that are listening, people that are in the industry, throwing around terms like hard money loan and things of that nature are kind of commonplace. But maybe for those listening that don't know, that haven't done their first flip, maybe talk a little bit about the differences between hard money loans and conventional loans.
Absolutely. So a hard money loan, there's sometimes a bad stigma depending on where you're getting your education from. But a hard money loan, the way to think about it is, at the end of the day, it's a tool. And as an investor, you have all these different financing tools to execute. When you're getting a conventional loan, typically the big banks want to see the property is in a livable condition. So that means it's rent ready and people can go ahead and move into it the minute you purchase it. Now, what happens when property is in disrepair, it's beat up, it needs a new roof, etc.? A lot of those big banks will shy away from that. There's too much risk, too much unknown, so they don't want to expose themselves to that. So that's where a lot of hard money lenders come in and why there's a marketplace for it, because we come in and help you buy the property and also provide renovations for anything that's needed. So that way you can take it from a beat up shape all the way into a fully stabilized condition where it can be move-in ready to keep it in your rental portfolio or even sell it in the open market as a flip to make a quick profit.
Okay. And so would you say, when you're thinking about hard money, kind of reminds me of almost like a home equity line of credit in the fact that it's not something that you would want to think of as like long-term financing. It's more of a tool to get yourself in a position where you can get into those the 30-year fixed loans or the longer term fixed conventional loans. Does that sound right?
Yeah, that's exactly right. Typically, the loan terms are anywhere between 6 months to 24 months. That's depending on who you're working with on a hard money loan. And then the traditional financing, typically those loans are anywhere between 15 and 30 years, but more commonly 30-year loans.
Gotcha. And how much would you say you need down in those two situations, hard money versus conventional, if you're thinking about structuring a deal?
Yeah, so conventional, if you're buying an owner-occupied property, you can get in as low as 0% down if you've ever served in the military through VA loans. And then if you're buying a second property or an investment property, typically the minimum is 20% down. Whereas on the hard money side, it can vary between 10 and 20% down. The main driver for what the down payment will be for you is experience. Typically, the more experience you have flipping properties, the lower the down payment. So if you've never done a deal or in your first couple, you should probably expect 20% down. But know that as you flip more properties or burn more properties, your down payments do go down.
Okay. Yeah, 10% is pretty good, especially given given the risk, but also given the upside on some of those deals that you do find that can't be traditionally financed or conventionally financed, but have that additional equity on the back end that you can earn. So that's actually really good.
Yeah, and you make a great point that because so when you buy the property, say the value is X, you demolish it, the value goes down. So if at any point when you demolish the property, the lender could be upside down, but then there's so much upside because when you renovate the property, the value goes up significantly higher. And that's why hard money lenders are willing to do as low as 10% down. I have something cooking in the books where we might be able to get a lower down payment, so stay tuned.
Interesting. Okay. And you're at certain lending now, right? And that's a national company. Is that right?
Yeah, we're national. We operate in 46 different states, and really my footprint though is very local. A lot of Washington, and we're always staying up to beat on what's new. It's what's going on with zoning regulations or even the wholesale regulations. So how we can pivot with our clients, because if we don't solve the problems that our clients are facing, then we'll get washed out of the market. So we're always trying to stay front and center with the new changes.
For sure. Would you say the rates, obviously that's a big, big talking point right now, whether it's conventional or hard money. Would you say the rates tend to trail or follow the Fed similar to conventional? For instance, if you have a 7% rate for a conventional and let's say a 12% for hard money right now, is there a typical spread you would see between conventional to hard money, like of that 5%, or kind of how does that normally track, just so that people could follow along and set an expectation there?
It's a great question. So usually what you'll see is the 30-year loans follow the 10-year treasury. And that's pretty standard. That's why a lot of people, when the Fed increases their federal funds rate, which is the rate at which banks borrow to one another, that tends to impact the 30-year loans. Now, the 10-year treasury, and the reason why we can't accurately put a spread between conventional and hard money loans is because hard money loans are actually pegged to a SOFR rate. So a SOFR rate is a different metric that banks use, and it's usually a spread of 4 to 5%. And that's a better depiction to understand where hard money and, as a matter of fact, new construction hard money loans are trading at. So when you think 30-year loans and what's going on with the trends, think about the 10-year treasury. And then when you think of hard money, it's SOFR rates plus a 4 or 5% margin.
Gotcha. Okay.
Yeah.
Interesting. I didn't know how that worked.
Yeah, there's definitely a second metric out there. Not a lot of people know, but it exists.
One of the things that I really like about my experience in working with hard money, it kind of reminds me when I was doing commercial deals as well. When you're doing a conventional loan, the banks or the lenders are really just looking at your income, right? They're not really looking at the investment. But when you work with Israel or you work with somebody on a hard money loan, these are folks that are experienced in investing. Like Israel talked about his background in investing and construction, and really has another level of knowledge than maybe your traditional lender might have. So they're actually looking at that deal from a risk perspective for themselves to say, is this client's comps, do they make sense? Does the construction cost make sense for what we see as the condition of the property? Is the development potential what they think the development potential is that what we think it is as well? So they're actually giving you another set of eyes on your deal, which, it's baked into the additional fee in my mind, because you guys are actually, another layer of protection, because you're not going to give somebody, these 80 to 90% loans on a fixer-upper property unless you also see the potential in that property as well.
And there's countless times I've actually denied more loans than I've actually financed, which kind of makes sense. And oftentimes I'm actually helping clients negotiate the deals for them as well. So I'm telling them, hey, talk to your contractor, see if you can compress the costs, or you can subcontract some of the costs out, and then simultaneously bring the purchase price down so that way your margins get expanded. That not only helps the borrower, the investor, get into a better deal, but also it's a better risk profile for us. And if I see a client doing any deal at 90 cents on the dollar, meaning the purchase price and renovations or 90% of the ARV, I'm telling them to walk away. Even at 80%, if they're not a very experienced operator, I'm most likely talking them away from the deal. So just know that is very true. And we're helping them a lot of times, guide them through those situations.
For sure. Yeah. So if you guys are out there, thinking about whether to use hard money, conventional, conventional is great. If a deal is in a position to be financed that way, and maybe you don't need additional money for the rehab, or you're planning to use cash or some other form of financing, but don't be scared of the fact that maybe it's a little bit higher in points up front or a higher rate, because you really do need to look at that as a tool and a way for you to take down a deal that's going to set you up for success and potentially make you a great return on the back end. So similar to with rates being high right now conventionally, like that's just one piece of the puzzle, right? So don't be scared of the real estate market, whether it's a conventional loan or a higher interest rate hard money loan, just because of rate by itself.
And the other thing, Ian, is that as I mentioned earlier, hard money is a tool, and so is conventional. It's a lot of conventional financing. So give you a perfect example. If someone's looking to buy an ADU in the greater Seattle area and the main house is in livable condition, I'm advising my clients, go conventional first. If you can if money is a problem, you can get in with as low as 5% down as an owner occupied property. You'll get the lowest down payment, lowest rates. So now you acquire with the conventional loan, and on the back end, once you're done with the condoization and permits, then you can go ahead and refinance just the main house and then get a hard money loan on the new construction build. So these are tools that you can combine them. You can do on one project, be taking out 2 to 3 loans. And that's exactly what a lot of the sophisticated builders in our market are doing. And as people are taking more ADU projects, we're combining programs all the time.
Yeah, that kind of leads into my next question. I was going to ask, you work with some of the best investors in the state, probably the country. What do you see, maybe, 2 or 3 things that you see these successful investors doing over and over again that really set them apart from everybody else that you work with?
There's a couple things. The main one is they always have cash on hand, meaning regardless of the number of projects that they're taking on, they're always sitting on a bankroll that they can tap into in case things go wrong. Anytime I've seen a market shift, meaning your ARVs are lower than what you expected, and you have 10 projects going on at a time, that can be a domino effect, and you can quickly find yourself in the hole. But a lot of these investors, they tend to, for instance, on the last market shift not too long ago, a lot of investors actually cut their losses and moved on and reset their underwriting criteria. Now, the investors that held on for longer were bleeding for longer and are still recovering today. So definitely having cash on hand for any project that you're doing. Let's dive deeper into what I mean there.
Yeah.
Having 6 to 12 months of reserves is a healthy amount. So cash on hand is the number one. Number two is they always have a constant pipeline of deals, whether it's a marketing machine that they're running on them by themselves, or whether that's creating a sphere of wholesalers and people in the market that are always sending them deals. That's the second piece. And then lastly, it's the execution, controlling their execution either by having contractors they trust, or by, as a matter of fact, understanding when your contractor's over leveraged and bringing in new crews, or even firing the contractor. So being a former general contractor, I didn't really dive into the details there, but when you're in the execution phase after you bought the property, your biggest risk is something going wrong in the construction piece. So you have to manage your contractors. It's not like you buy the property, give them the keys, and say, see you later. Let me know when the project's done. You actually have to manage them, make sure that they're following your designs to the T, fixing anything, making sure they're not cutting corners. But those are the three things: cash on hand, a strong pipeline of deals coming in, and then managing their contractors effectively.
Okay. Those are really great tips. Yeah. I mean, the other thing that I see is people continuing to focus on that earned income. And that kind of ties into all of your points that you just made, really. But, people don't just, if the successful people, they don't just buy a deal, start working on it, and then take their finger off the pulse of their other businesses, or maybe their wholesale income, or even their W-2 income, right? They keep the earned income flowing to be able to manage any sort of risks with higher construction costs or anything else going on. So you really do have to keep, multiple, I would say, streams of income going, and just, multiple irons in the fire, and just, a lot of things moving at the same time. Yeah. So multitasking is a must.
I'm glad you pointed that out. That is something that I see amongst a lot of investors, where they almost have like 3 pillars of income generating activities, whether that's wholesale or real estate agent commissions, flips, and even wholesale transactions. And then, of course, the last one is they keep some of these properties to continue to grow their wealth and tax purposes. But if you're just starting out in real estate, the number one thing I would say is surround yourself around people that are farther ahead, that are on the same track that you want to be, but are farther ahead, whether that is a close group of people or even mentors, because you don't know what you don't know. And those group of people will help bounce ideas off, and you can ask questions on whether a deal is a deal or not. So that's what I would say. If you're starting out, definitely surround yourself around folks that are doing what it is that you want to do and are farther ahead.
For sure. What percentage, just high level, I'm a big, buy to own and hold long-term proponent. What percentage of folks do you work with? You work with a lot of flippers and developers. What percentage would you say actually takes some of those flips and holds them as rentals long-term versus the folks that are consistently kind of on that additional hamster wheel of like flipping with no end in sight?
I would say it's much more geographic dependent.
Okay.
Meaning anyone flipping or building in high price point markets, a lot of their income is coming either through flips or new construction developments, but very rarely do you see them keep a property. Out of a single in Seattle, we have these ADU packs where you can build a single family, an attached ADU and a detached ADU. Out of those, I see them keeping maybe one. And then out of larger townhome developments where they're building 7 or 8 townhomes at once, they're keeping at least one, if any.
Okay.
So it's a very low percentage. Most people in high price home markets are actually selling. And then the folks that I see keeping or borrowing more properties are actually in the Southeast or the Midwest. So Ohio is very popular right now. Cash flow is great, appreciation not so much, and same with the Southeast. You've got North Carolina, South Carolina, Tennessee, Georgia, and Florida, where I'm seeing most folks actually keep properties for long-term and rentals, right, because it's got stronger cash flow than higher price point markets.
Yeah. No, that makes a lot of sense. I see a few people that I really follow on social media that really have it dialed in terms of, I think it is the Ohio market, buying a property for 100,000, putting 50 into it, and then it's worth 200,000 or whatever it may be, and then putting $140,000 loan on it, barely keeping, or maybe even $150,000 loan, recapitalizing, and then they're actually able to cash flow with a $150,000 mortgage on that $200,000 property, and maybe renting it for, let's say, $1,500 a month. So those types of deals, you can just rinse and repeat over and over again, and really build a massive portfolio with single family rentals, just because the numbers work out so well like that in that area. But to your point, when you're in the Seattle market, at a $700,000 to $800,000 entry price point, even if you are able to create 30% margin on the front house plus the dadu, you might be breaking even with that 35% margin. So you really do have to continue to keep that earned income coming in, or flip other types of properties. Really not be solely focused on cash flow for those types of deals. So it's just an interesting dynamic when you really have to understand the market in your own backyard to understand kind of what's the play there. What do you where do you see the market? Oh, go ahead.
And there's two. I'm glad you bring it up. There's two dynamics there. It's one school of thought where a lot of investors early on are focused on, hey, I want to replace my W-2 with cash flow. And then there's another school of thought of, hey, I'm young, I'm making good money, I'm in the growth phase, and I'm going to not focus on cash flow, but just focus on growing my portfolio, even if it means that I'm breaking even. And one of them focuses on cash flow, getting rid of the W-2. But if you're in a high price point market like the greater Seattle area, I think focusing on growth and acquiring good real estate in prime locations is a far superior strategy, because the appreciation is much larger than any of the cash flow, where you can 1031 easily within a couple of years into larger projects and grow your portfolio faster. So those are two interesting dynamics that a lot of folks starting on earlier tend to struggle with, for sure.
Right. Are you personally investing in the broader Seattle market? Or are you also dabbling in some of those other areas around the country, or kind of personally, what do you prefer?
I love new construction over flipping. It's much more predictable, and I do anywhere between 2 to 3 job sites a year. It can be multi-unit sites, whether it's townhomes or ADUs, but I do try to focus on new construction, buying 2 to 3 sites a year, so that way I'm not running a bunch of sites. It allows me to lower my overhead costs, and I'm not buying deals out of FOMO or just because of social media. I'm buying home run deals and deals that actually make sense. So that's why we keep such low volume. And we are keeping about 1 in 7 new builds.
Okay.
So that's my main bread and butter on what I focus on.
There you go. Yeah, I think people do overestimate what they need to do in a given year. When you really see the people that have had success in real estate, it's not, they didn't do 100 deals in 1 year and stop. It's maybe a few deals a year, keep one for 10, 20, 30 years, and then all of that is what adds up. It's not burning yourself out or getting taken out by a downturn in the market or an increase in rates. It's just a matter of how long can you stay in the game and keep that money working from you or for you and compounding. So it's a great strategy for sure. Do you
you wanted to connect? Oh, go for it.
Yeah, I was just say, where do you see the market going in these next couple of years? It seems like it's just been so hard to predict lately in terms of rates going up, but then prices continuing to go up. It looks like we've kind of stabilized a little bit from a pricing perspective, and the latest I've heard is forecasted rate drop in September, it sounds like. So what's your crystal ball say or see in terms of where we're headed through the end of the year here?
We're definitely predicting September, November, another rate drop, and then potentially a couple more in 2025. I want to see one rate drop and see what that does to the market. I would not like to see a bunch of rate drops in 2025 because then we're going to have an inflation problem again.
Yep.
So I in an ideal world, I'd like to see rates for homeowners stabilize in the 5% range, and then for investors somewhere in the sixes. That should fuel the housing market back up again. Anything below that, I think we're coming out of a bad time. So the times of rates in the threes, fours is probably gone. This is kind of like the new normal, kind of the fives, sixes for homeowners, and then sixes and sevens for investors. So that's what I would like to see as far as a crystal ball and what I expect for the real estate market. I think we'll have a couple things. You've got AI integration coming in. You've got urbanization because we have a shorting of housing. And then we've got zoning changes. And I'll dive into each three of those. So on the AI front, it's here. It's here to stay. Some people are scared of what it's going to do to their jobs, but ultimately it's another tool to make us more efficient. And as operators, we need to understand how to use it and integrate it into our businesses. We're actively piloting it for our underwriting staff to be able to give them more capacity. So I think any way you can integrate AI, whether that's as simple as replacing Google search with ChatGPT, I think that already cuts a lot of time out of doing searches for whatever it is that you're trying to do. And then urbanization. We know that there is a shortage of housing. So I do expect to see more and more new construction developments to come out of. You can imagine anywhere where there's a core market, you will eventually run out of land once you overbuild it. So the only thing to do is sprawl out. And it's also an affordability thing. The closer you are to the core, the more expensive homes are. And not everybody is making the money needed to go ahead and buy real estate in those core markets. So that their only option is to continue to expand out. So I think there's definitely going to be builders that are going to satisfy that need. And then the other piece that we're seeing a lot is zoning changes. So in those core markets where there isn't enough housing, the only option is to go vertical. Instead of keeping an oversized single family house, I'm expecting LA, San Francisco, Portland's already there, Austin, Texas, Tennessee to basically change your zoning regulations so on a single family law, instead of having one unit, you can have multiple units. And we're seeing that firsthand here in Washington already unfold. So I think that's going to be a very exciting time for investors and homeowners to be able to buy new homes at a potentially medium price point.
For sure. Yeah, we're already seeing that in Seattle, and I know we've talked about this before, but I'm super excited about the opportunity. You know, I've been diving in these last few years, just trying to learn everything I can about where the Seattle market's headed, where the Tacoma market, and just being an expert, you know, on the forefront of that. Seattle was, I think, we're about 5 years into this this zoning change, and it's going to change again next year. But you know, for you watching, if you want to get into real estate and really be you know, at the forefront and take advantage of this opportunity, you know, just spending a little bit of time researching your local zoning code, or even, you know, going on your local zoning website, you can find out so much about where things are headed. When I first started, my strategy was really to follow the light rail, you know, in Seattle, because I knew wherever the light rail was going to be going, there'd be billions of dollars of investment around that. And to your point, that's like where those vertical zoning changes are going to go. That's where all the you know, mixed use residential and all the investment's going to go. So that's played out well. But this is just another example of that, of understanding where are things headed. And you know, there's a lot of people talking about the ADU and DADU opportunity, but not that much, you know, not that many. Only if you're in those circles, you hear about it a lot, but the general public is still a step behind. So, you know, super excited. I know rates are high. It's tough to get into the market, but if you can figure out how to tap into the ADU and DADU opportunity, or I guess broader zoning changes, or really any of the the 3 points you mentioned, technology, the urbanization, and the zoning changes. That's going to be your bread and butter on how you can get into real estate these next few years.
And a popular strategy that I've been seeing and coming from a lot of real estate agents or my conventional lender buddies is a lot of savvy agents and buyers out there. They're not feeding into the narrative of high rates. They're actually saying, okay, so be it, rates are high. What are we going to do about it? How are we still going to get into real estate?
Yep.
And they're negotiating rate buy downs. So that's kind of like the way that you can get into real estate today with lower rates by negotiating that the seller buys your rate down, so that way you can get in with a lower monthly mortgage payment. And then when rates come down at the end of this year or next year, you refinance. So that's how you get in the door today, by having the seller pay for the buy down, so that way you can get a lower interest rate. So that's a strategy that anybody could use today to buy, whether that's an investment property or either your first home. Now you could potentially put an ADU in the next couple of years.
Right. Yeah, it's amazing the number of people that don't think past that first line of defense, right? Like the first line of defense is rates, but it's like, okay, and then what? And like there's answers behind that, right? If you unlock that door, there are answers, there's strategies, there's people like Israel that can help you navigate that. So don't just see that rates are high and stop the conversation and just take yourself out of the game, right? Think beyond that, and you'll be rewarded for it, in my opinion, if you can kind of figure that out.
Yep. Well said.
So going forward, you've already had massive success. You're a young guy. What do you kind of see, these next few years here with your own business, development business, and kind of, how do you see that playing out? And then how do you plan to continue helping your investors and your clients reach their goals as well?
So the strategy hasn't changed for me in the last 4 or 5 years as a lender. It's going to continue to be relationships over transactions. So I strongly focus on who is in front of me, who am I helping today, making sure that we knock it out of the park for them, and let that continue to evolve. Now, outside of the individual transaction, things that we're doing are staying at the forefront of zoning changes, so that way we can provide solutions to anybody looking to take advantage of opportunities. And also, like, the wholesale industry right now is up in arms. There's changes going on where, as a lender, we can either wholesale. The concept of wholesaling may go away. It may not. It may get repackaged into something else. I can think of, instead of wholesaling, they could call it the new way, finder's fees, or an invoice for finding a property. But I don't think for instance, a wholesaler is definitely needed and required in a investor's life, because they find deals, and at the end of the day, it's a win-win. The wholesaler gets paid their fee for all their time and effort, and then the investor gets a deal. I don't think that's going away. It's more just weeding out the bad players that have been taking advantage of individuals and not actually providing one-on-one situations to sellers. So I think there's more regulation coming down the pipe on that stuff, but even providing transactional funding for anybody that finds real estate and needs to go ahead and sell it to an end investor is something that we're thinking about and actively staying at the forefront, because as the market shifts, so do we. So we have to pivot with the times as well. So that's what I would say. Definitely focusing on whoever's in front of us, and then continuing to change with the times as well.
I love it. Yeah, I'm definitely excited to see. It's been great following your journey these last few years and kind of seeing that growth. Seeing you at a lot of the big meetups and speaking, and you can tell you're just getting started on the journey. So definitely excited to follow along on these next few years here. See where you guys can take it.
I'm pumped.
Yeah. I know we're getting a little bit short on time here, but before we finish off, one question I love to ask all of our guests that come on the show is, why do you love real estate?
I think I've always known that I wanted to be real estate, as I mentioned early on. I never knew what it was that I where I would find my passion. It wasn't being a real estate agent. It wasn't being a general contractor, even though I operate as my own general contractor for our own projects. But it's truly the lending side keeps me on my toes. And at the end of the day, at this point in my career, it's helped me create friendships and family that I wouldn't have otherwise. So the way I view it is I'm playing the game and having a blast with a bunch of friends and people who I consider family. And work is no longer work. I'm just helping my friends and family. And that's what I love about real estate, meaning I can go to work and not feel like I'm working. I'm having a blast helping my friends and family. So that is where I think I finally found my place. I will still invest in real estate, but definitely I like seeing other people succeed and enabling them to succeed.
For sure.
Yeah, it's definitely one of those few industries where you can really have a win-win on everybody involved in the transaction, whether it's the seller, the buyer, the lender. Everybody can win and feel good about the deal that was done and the relationships that were built along the way. So can echo that for sure.
Yeah.
So what's the best way, that was basically a master class of lending and construction, where things are headed next. For people that want to reach out and learn more about you, learn more about your business, or potentially bring some deals to you so that, they can get their foot in the door in real estate, what's the best way to reach you and contact you and kind of go through that next step?
Yeah, best way is reach out, send me a message on Instagram. So you can find me at Israel_Lopez_exhibit, and more than happy to connect. From there, we can grab coffee, do a Zoom meeting, strategize where you're trying to get to, and at the end of the day, help you.
Awesome. Yeah, we'll put all that in the show notes. Make sure you guys reach out to Israel, follow him on Instagram, follow his journey. And thank you guys all for watching. Thank you, Israel, for being here. And can't wait to see what's in store for you next, buddy. Take care.
Thank you, Ian. Appreciate you. Thank you for having me.